In this video, we're going to be analysing Taiwan Semiconductor, or TSMC as it's known. Ticker symbol is TSM and it's traded on the New York Stock Exchange. We recently ran a poll on the Patreon page to decide which stock we're going to analyse next on the channel, and the winner was TSMC. So in this video, we're going to review the business and its operations, analyse the stock's performance, look at the potential growth based off of what we know about their current product offering and any potential catalysts that the stock may have. Then create a forecast and valuation model for TSMC to see if the stock is currently at a fair price to buy today. If not, put a price target on TSMC to maybe buy at a later date if we get a dip. So TSMC are a semiconductor manufacturing and design company that operates a pure play foundry business. This means they don't design or market any semiconductor products under their own name, but instead is contracted by customers such as the likes of Apple, Qualcomm, AMD and Nvidia to manufacture the chips that they design. A lot of you, and maybe most of you, will be or have at some point used TSMC's products. It's just been marketed under one of their customers' names and products. You see, the chip making industry is one of the leading forces behind technology and innovation in the world today, and you could go as far to say that it dictates the pace of change in many areas. And this is because chips are essentially the brain behind all of your household devices, such as smartphones, tablets, TV, computers, and video games. These all contain technology that was produced by semiconductor companies such as TSMC. For TSMC, their largest technology that they serve is smartphones, followed by high-performance computers and the Internet of Things. And they're good enough to give the growth rates over here, which is good to see, and they're all growing at a rate above 20%. And as we know, these are all high-growth industries within their own right. And additional to this, the majority of TSMC's revenue comes from the US, with over 70% of coming from the US in Q4 2020. So they're highly concentrated to the US. And this is mainly because Apple is TSMC's largest customer, accounting for over 20% of revenues. And you've also got AMD and Nvidia in there, who are two of the largest customers as well, based in the US. And due to the stock performance, TSMC is now the largest semiconductor company in the world by market cap, boasting a market cap of nearly 540 billion. The stock has been on an amazing run, as you can see, since sort of March, April last year, with it almost tripling in 12 months. Remarkably, though, the PE is still not outrageous, with the PE floating around 34 to 35 times at the moment. And if we look at the fundamentals, we really start to see why. For a company that operates within a highly cyclical industry and that is very capital intensive, they've managed to have a very smooth and consistent rise in revenue and earnings over the years. This is a 10-year period that we're showing here. You can see that curve up is very nice. And 2020 actually proved to be one of their most successful years on record. They managed to grow revenue at 27% and operating income at 54%, up to nearly $20 billion in operating income for 2020. And that growth is even more impressive when you think about they were already a $35 billion company before that. They're now $45 billion in highly profitable revenue. Now, the past is great, but we want to know about the future, and that's why we're here in this video at the moment. So, as we can see here on their website, they talk about how good of an investment they are, delivered excellent financial results, 17.2% compound annual growth rate since the listing in 1994, which is a fantastic growth rate. You have to give it to them. 20% return on equity, so quality growth as well. Fortress balance sheet, all of these things. But what's interesting, they give some punchy objectives as well going into 2025. So they've got a financial objective for revenue growth between 10 to 15% from 2020 to 2025 in US dollar terms. Gross margins to be around 50%, which they're near to now, and then operating margin at around 39%. ROE has to be above 20% as they have done previously. Everything is to be funded by organic growth. So that's going to be funds only that the business produces themselves, rather than raising debt or issuing shares and things like that for more money. Additional to this, they are committed to paying sustainable dividend, not a huge dividend, but around 1.5%, I think. 1.4%, and they started paying these dividends in 2004, and looks like they have no plans to cut it or reduce them and invest them back into the business. Currently 8.8 billion that was paid out in 2020, so no small amount. And what's nice is they have this monthly revenue tracker as well, which we can see Obviously, we haven't got Q1 2021 yet, but we can see that they've got their net revenue amounts in there for January and Feb. They're currently at 22% over on January and then 14% over on February. So they're well in line with their guidance that they've given so far, albeit this is 5-year guidance and this is just 2 months of the first quarter of 2021. But nice that you can see that happen in real time. And they also have a spreadsheet that you can pull as well that you can see the monthly revenue and then make out year over year. So essentially you can just track these guys based off the guidance that they've given and how well they are sticking to that. And when you think about the industries that they serve, just think about smartphones, gaming, computing, high performance computing, Internet of Things, smart devices, communication devices. Do you think in the next 5 years, is the world going to have a higher demand for those things, or is it going to have less of a demand for those things in the future? I personally feel that there's going to be a bigger demand for those things. So when we start to think of the companies that operate within those industries that would use the likes of TSMC, then you're thinking about companies like Apple, you're thinking about companies like AMD and Nvidia and Sony and people like that, technology companies, some of these companies that don't manufacture their own chips but need chips to operate their products. Now, TSMC is probably going to be the biggest beneficiary of all of this going into the future. And TSMC are recognizing that there's going to be this increased demand over the next few years. And they've come out recently saying they're planning to spend $100 billion over 3 years to grow their capacity. And the reason behind this is that we are now at the center of a global chip supply crunch because, like we've seen, the main dominators of the market are TSMC and Samsung's foundry business. There's such a high demand for chips at the moment, and they just don't have the capacity to keep manufacturing them at the pace which they're needed. So they're willing to spend even more over 3 years to grow this capacity and focus on how that's going to build out earnings into the future. And in my mind, of course, this looks like a big number on the face of it, and people might start to think, is this going to hurt earnings? And you know what, maybe it will, but for the long term, it's going to be one of the best things that they can do, especially if they want to retain that 55% market share. They're not going to be the only people who are spending aggressively on manufacturing capabilities. Obviously, Intel is one of their main competitors, and Samsung as well, who's another pure play manufacturing business. And in my mind, the demand seems to be there. They wouldn't be spending or committing 100 billion capex over the next few years unless clear signs of demand were already there, in which I think we have seen with the global chip supply crunch. Now, look, in my eyes, they've given us guidance for the next 5 years that we should probably take seriously, because the management team and people within the company are going to be best suited to know what the next 5 years looks like for the market and for TSMC themselves. So to screen the stock, maybe get a price target, see if it's at a fair value today. I'm going to plug these assumptions here into a valuation model, give you my opinion on whether they can achieve it, whether they can underachieve it or overachieve, and then also touch on maybe some of the risks involved. Now, here's my valuation model for TSMC. So I've taken their guidance and the top end of that, which is 15% into 2025, and that gets them to 91 billion of revenue at that point, with their target operating margin, which they're averaging around about now for the past 5 years, which is 39%. Their free cash flow, I've gone with 57% of that earnings metric, because that's what they've averaged over the past 5 years. But they didn't lie when they talked about having a fortress balance sheet. They really do. They've grown cash and reduced debt every single year for the past 5 years, which is great to see. We can see they're currently selling at a 31 times EBIT multiple. That multiple does start to come down with this growth, albeit only to 17 times 2025 expected. But all of this is a 15% growth rate within a total addressable market expansion, or TAM, growth rate of only 9%. So this would mean that they outperform the rest of the market by quite some way, by about 60 percentage points. Now, for my terminal values, I've gone for a market multiple. I've gone with an EV to EBIT of 25 times, which I think is more than fair, considering at this point they're going to be growing at around 15%. So the PEG ratio would be around 1.67, which is a reasonable price to get in and sell a stock. You wouldn't argue with buying at 1.67, but you wouldn't be too sad about selling either. Also, 25 times is less than it's selling for now, so we're saying that the market stops putting as much of a premium on TSMC in the future. Now, that gives us an enterprise value of almost $900 billion for TSMC in 2025. And once we add back the cash and then less the debt, which there isn't much of anyway, we get a market cap of $916 for the entire company, which is a share price or price target of $176 per share for the stock in 2025. Now, discounted back at a 13.5% discount rate. And the reason why I've dropped it to 13.5% for this one is because they currently have a 1.5% dividend yield. So I'm just taking that out of the discount rate because we're going to be receiving that as cash anyway. I don't usually do this because I'm not a big fan of receiving dividends, especially on US companies or international companies where I only receive around 60-70% of it by the time it actually gets into my pocket. So that's why I prefer to just go with a 15%, which is my required capital gains rate. But we've got 13.5% to fairly reflect the discount rate, and that gives us an intrinsic value for the company today of $496 billion or $95 per share. Unfortunately, that means that the stock is overvalued because it's at $122 per share today. So it's currently 21% or 22% overvalued. Now, there's always the chance it could drop. Back in June, it was only at $50 per share. So we're talking about, almost a double in less than 6 months. So it has started to sell off recently. We could see it drop back down to 95, which is my fair price, and I'd probably welcome that. But let's quickly go back into the valuation. Let's look at if they hit the lower end of their guidance, which is at 10% revenue growth rate up until 2025. That's only $73 billion in revenues versus 95 at the same operating margins, same free cash flow margins, and everything about the balance sheet remains the same as well. Fortunately, that means that it's even more overvalued and that a fair price to pay would be around $77 per share. This is also not accounting for any changes in the terminal value multiple. So let's take, for instance, if for some reason Taiwan Semiconductor in the next 4 to 5 years starts to have issues with manufacturing and it starts to be valued similar to the likes of Intel, which is one of its competitors. Obviously, Intel has had a really hard ride over the past 5 years with the stock really stagnating, shooting up very recently though. In my opinion, it did get very much undervalued. It's currently selling at a PE though of 13 times. And you can only imagine that if Taiwan Semiconductor was selling at that in the next 5 years, how bad of a return you would have if you paid for the stock at $122 per share today. That would mean that current price is 62% overvalued. So I'm just trying to show you the risks that are involved in this one. I personally think that the upper end of their guidance, that 15% with probably a 25 times multiple, is around about a fair estimate for what TSM will do over the next 5 years. So I'm going to put a price target on TSM of $95 per share based off of these forecasts and based off what I think is likely for them. That still means it's overvalued by a fair bit, but there is always the chance that we could see it drop back down to maybe it's November or October levels, and then I'd think about maybe opening a position there because it is a company that has some really big tailwinds behind it going into the future. Such high demand for its products. It's had a consistent track record of performance, and I think it's going to do very well over the next 5 years. That just about wraps up this video, guys. Hopefully you enjoyed it. Let me know in the comments if you own TSM or if you're thinking of opening a position. Any feedback you have on the valuation and the estimates, I'd be happy to hear them. This spreadsheet, as always, will be available to Patreons on the Patreon page and on the Discord. So go over and check that out if you're interested in supporting the channel or also, want access to various other valuations that we have done and then other benefits as well, like our watch list with target prices. So we're keeping track of these valuations as we go along and then adding some new ones onto it. So go and check that out if you want to support the channel. If you enjoyed the video, leave a like. I'd greatly appreciate that. Subscribe to the channel if you haven't already. And I'll see you all in the next video. Good luck with all of your investments.